Hello and welcome to BQ Prime. Today's retail inflation figures have come in as a little bit of a shocker. Inflation has risen by 7% in July compared with 4.87% in June. It's also significantly ahead of Bloomberg estimates, which was expecting inflation at 6.4%. To share his insights, we're joined by Saugata Bhattacharya, Chief Economist at Axis Bank. So thank you so much for taking time out for us today.
Thank you so much for having me on your show, Pallavi. Always a privilege.
So to begin with, what are your early takeaways from today's figure? Along with vegetables, there seems to have been a significant rise across food items, cereals, pulses, and so on.
So yes, food was the major contributor to the very unexpected the actual print of 7.44%. We at Axis Bank, our own forecast was 6.7% with a distinct upside. I wouldn't have been surprised. I mean, given, as you mentioned, given the range of items which are showing inflationary pressures, with a 7% print, but a 7.44% is actually quite high. I'm told that non-food inflation, CPI inflation, is actually 5.4% as opposed to 5.2% in June. So that means, fuel has also risen significantly, and as you would have expected, that many components of fuel, given the fact that in July, the price of crude has gone up significantly compared to the month of June. So I wouldn't be surprised with that. The worry now is that this might actually persist for a fairly long period of time. Remember, I'll get into details as we discuss in more detail later. But it's quite obvious that with a 6.7% base forecast that we had for the month of July for CPI, August print was about 6.3. Would have been is likely to have been about 6.3. Everything now would have gone up. Remember that RBI's forecast during the last monetary policy the review for the entire quarter was 6.2%. So now with this print, that will probably be overshot significantly from that number. So given and going by global forces on food, non-food commodities that we are now beginning to see, this is likely to be a headache and a problem for policymakers for a few months at least, if not more.
Sure. So, delving a little bit more into the internals, even the RBI at its last resolution was expecting higher inflation for this month. The expectation going ahead was that vegetable prices would soon ease and we would get some respite from inflation figures. But like we spoke, it's a multitude of food items which have shown a substantial increase in momentum: cereals, pulses, meat, and in case of some of these commodities, unlike in case of vegetables, we're not sure if these prices will crash anytime soon. So what's the way forward?
So you're completely right. That this is much more broad-based than we had initially thought. So hopefully the good news is that the prices of tomatoes have already begun to come down. In Maharashtra, say for instance, yesterday, prices of tomatoes was down for 37%. With now fresh imports coming in from Nepal, from what we have been told, I think the price of tomatoes is likely to come down soon. But the other commodities are likely to remain quite niggling. Added to this, global food prices, which is the worry part, is beginning to go up significantly because of the Black Sea embargo. Other commodities, prices of wheat, corn, other commodities have risen because of all the weather-related disturbances. Prices of rice, and particularly with the India's export ban on rice, prices of rice globally have shot up. Good news is that global food prices don't typically come particularly to that extent into India's domestic produce, and there are non-monetary tools, monetary policy tools, to try to keep prices more stable. Utilizing the government stocks in terms of cereal stocks that the FCI holds, importing more food grains and vegetables. The government is releasing onion prices. Onions have begun to go up. So the government is releasing onion stocks. So to a certain extent, these large, more the fiscal tools, the trade tools, etc., will be brought into effect. But the problem is that together, from the global side, what is likely to impact is the prices of petroleum, crude, and other petroleum products going up, because that has an immediate impact, and that we have already seen in action. Prices of fertilizers have already gone up. Urea, DAP, potash, etc. Prices of fertilizers have gone up. So if the government now, in order to keep domestic fertilizer prices, the landed at the farm gate fertilizer prices stable, I'm sorry, they will have now to resort. They will now have to resort to higher subsidies of fertilizers, and that will have an impact on the fisc, and that will have an impact on interest rates. So I mean, the actual repercussions of whatever is happening globally and domestically on prices will have an impact on a much broader macroeconomic and macrofinancial spectrum.
Okay, so that's a lot of headwinds you've outlined. I also want to know a little bit more about the monsoons. So far, on a positive note, sowing has exceeded what it was at the corresponding period last year. Of course, in case of some commodities like pulses, sowing is still lower than what it was. However, going forward, there's considerable uncertainty continuing still. We still don't know what the impact of the El Nino will be, and what's the interplay with the Indian Ocean dipole conditions. So, how are you looking at that?
Well, I mean, I'll speak very generally on the meteorological conditions. It's difficult to keep track anyway of economic conditions rather than having to go into meteorology. But there are a couple of things that I would like to point out. You're completely right that I think sowing has been much better. And given the rains that we have seen in July, moisture, even in the east and the northeast, which had seen deficient rainfalls, there has been a little bit of a catching up even in those areas, which are large rice growing areas. So hopefully, I mean, August rainfall is predicted to be deficient. It's not going to be as good as in July. But I think that moisture on the ground, etc., I think we are more or less past in terms of meteorological conditions, in terms of the rainfall. I think more or less we are on the right track. So even if it's a little bit less, I think we are okay. But the problem with the El Nino, and I don't think the El Nino is expected to set in a very, very deep El Nino, is likely to set up, is expected to set up in September, which will largely bypass India. But again, I mean, coming back from the global side, it's likely to hit the Southeast Asian economies, the Latin American countries quite badly. And remember, the Southeast Asian countries are very large producers of oil, edible oil, palm oil in particular. So that the edible oils prices has been more or less muted. It's beginning to creep up, but it's more or less muted. So at some point in time, with the Indian domestic crop produce beginning to get inflation, food inflation down, edible oils prices, and to a certain extent pulses, the other commodities that we are dependent on, that we import, those might begin to contribute to food inflation in India going forward. But hopefully, fingers crossed that it will not, the meteorological conditions will not be another large shock into India. Hopefully, given that, food prices will eventually, September, October, or wherever, begin to stabilize, and that might open up a little bit of relief for the policy authorities.
Sure. Okay. So, in terms of monetary policy, now at the last monetary policy committee resolution, we saw that at least going by the RBI's commentary, most economists were of the view that rate hikes are unlikely to happen anytime in the current fiscal year. Does today's sprint add to uncertainty around the monetary policy committee? What's happening on that front?
No, you're absolutely right. The MPC's statement that they had looked through this, they were prepared to look through this very, I mean, expected high inflation print for the month of July. But remember that ominous sentence in governor's statement that while this increase was idiosyncratic, but if these idiosyncratic pressures consistently turned out to be persistent, then MPC would have to act. So our fear is that if indeed, given the risks that we are discussing, that food inflation, either imported or domestic food inflation, continue to be relatively high. I don't think you'll get another bad print like this in the near months. But say, I mean, the RBI's own forecast for this quarter of 6.2% gets exceeded significantly, the optics would look bad. So at this point in time, number one, I don't think a rate hike is a zero probability event now. I think it's a low probability event because, I mean, food inflation, particularly if it remains persistent, using interest rates is a very blunt tool. I mean, it has very adverse impacts across economic activity in the country. So they will resort more to fiscal policy, trade policy, other policy, food policy, etc., to try to keep farm inflation, food inflation lower. But it's not a non-zero event. I mean, if actually it sticks on at a high level, the worrisome part is that, remember, just 2 or 3 months back, we were thinking that maybe RBI would have room to cut rates in the last quarter of the January to April months. That has now completely gone out the window. People were expecting even a couple of months back that maybe the RBI would have, MPC would have room to cut in the first quarter. Given the MPC's the forecast of 5.2% for the first quarter of FY25, even that is a very low probability event. So if at all we see a rate cut, a repo rate cut, that will only happen in the second half of FY25. And given the fact that India's economy, aggregate demand, services is showing the kind of resilience that we are seeing, frankly, at this point in time, there is not even a need for a rate cut. Quite leave aside the room for a rate cut. It's probably not even required at this point in time. And of course, it is now to a very large extent dependent on what the global G10 central banks do. And I foresee that they would like to keep their rates higher for longer, given the fact that their inflation rates, although coming down, has been remarkably persistent, and it's way beyond the 2% targets that all of them, the G10 central banks, have.
Sure. Okay. So, I do want to ask you a little bit about what's happening on the growth front. We saw IIP figures were released on Friday. They weren't particularly encouraging. Neither was trade data that came out earlier today. So, what's the growth picture looking like?
So, first on the trade data, that is very clear that, I mean, whether the global economy is slowing or whatever, whether there is likely very low probability of a deep recession in the major developing countries, trade is slowing. So there's no doubt about that. Global merchandise and services trade is likely to slow in the world, and that will inevitably have an impact on the domestic trade numbers. We have seen that manufacturing merchandise trade has been negative for a number of months now. I'm sure I haven't seen the today's numbers. But it's likely to be negative or just about zero or thereabouts. The worry on top of this is that services trade growth, which had been very high throughout most of FY23, the last year, calendar 2022, is now down to zero. So that is a worry. So, given the fact that that trade as an instrument contributing to domestic growth, GDP growth, is low, it's likely to pull down GDP growth for FY24. On top of which, the other main contributor to the RBI's probable contributor to the 6.5% forecast for GDP growth, and we were also close, 6.4% for this year, was the low inflation, because that would pull down the GDP deflator from nominal to the real 6.4, 6.5% growth. So now with these kinds of numbers, and it's likely to have an impact on the WPI inflation numbers as well. So the deflator is likely to be much larger than we had earlier expected, both WPI and CPI inflation, and that will keep growth low. So it is probably a little bit too early, given what we were talking about, the resilience of India's economic activity. But we should be prepared for a shading down from the numbers that we are currently working with, the 6.4, 6.5% growth. If both inflation remains high as well as global trade begins to slow down even more, particularly on the services front. That is what is the bigger worry, because the way that the tech budgets, etc., are being cut down on the developed markets, it's likely to be a big problem. China remains a big, huge concern. What kind of stimulus is given in China? What kind of if a stimulus comes in, the global commodities, metals prices will probably start increasing. So that will also have an impact on India's inflation. So there are multiple moving parts in this equation, but I probably agree with you that we should be prepared for a shading down of the RBI's growth forecast of 6.5%.
All right. So I know it's a little bit early to be going there, especially considering how volatile vegetable prices and several other food items have been. But can we at least say that the next inflation figure will be lower than this one?
You're right. It's a very high probability. We were earlier thinking 6.3%. As of now, I mean, given current prices that we observe in the markets, maybe that will come up at 6.5% or thereabouts. But it's very unlikely, because I mean, remember that a large part of this is due to, I mean, from the vegetables numbers, large due to tomatoes. And given what we are seeing in terms of the prices of tomatoes, of course, there can be another shock for all you know. I mean, some
True.
rainfall related
Yeah.
disturbance in some states, in a few key states, might again push tomato prices higher. But I think the probability of getting another inflation print above a 7% is quite low at this point in time. It will probably be between 6.5, 6.3 to 6.7 or thereabouts as of now, I mean, given current conditions, but very unlikely to be even near 7% for the month of August.
All right. Thank you so much for taking time out. This was a most insightful conversation, as always.
As always, Pallavi, always a pleasure to be on your show. Thank you so much.
Thank you.